your general advice, I understand, is remain defensive until later of next year. Can you define later for us?
Sure. So we have been defensive for quite a while now, but we don't think this is still time to buy the market. There are two things that needs to happen to do so. One is earnings. Some of the earnings forecasts still remain elevated, especially in the face of a possible recession next year. And that's true in the US and in Europe in particular. The second thing is valuations. We have seen some rebound of risk on in Q4 this year, and that pushed valuation a bit higher compared to where the yields are. So typically there is a good relationship between valuation and yields, and we have seen some disconnect in Q4. So the valuations still need to come down, and that's particularly true again in the US. So we are waiting for that to happen. We are waiting also for more clarity on the Fed and central bank's policy, which we will get this week. And for that, we are waiting for that to happen to take more risk.
Okay, so you're looking for those turning points, whether it's on the Fed or even just a Fed pivot or a China pivot. Out of those two, Thomas, what looks more certain to you?
So I think the China pivot is already ongoing. Zero COVID was really the thing that was holding the recovery there, and this is basically gone. So I'm not sure how long it will take. It can take 3 months, 6 months for China to live with COVID as the rest of the world is doing. But it's pretty clear that if you invest for 6 to 12 months, there is a better environment for China. So as we look at the recovery in retail sales, for example, that will boost the economy. We have also good news on property, where there have been some support recently. So definitely the China story looks quite exciting, given that inflation is also not as strong as it is in other markets. So we are more constructive on emerging markets, including Asian equities and Chinese equities, than we are in the rest of the world.
Yeah, and we have seen already markets run with a China story, the obvious reopening names, Thomas. What would you advise clients right now looking maybe to chase this rally further if it does have more legs, more upside over the short term?
Look, China is an interesting market because it's heavily driven by retail participants. It can also drive a lot based on some news, and so that's why I will be a bit cautious. But if you look at valuation, it's single, close to 10 digit. So you have really a good entry point for an investor who might have a year or plus ahead of them. So I'm not really saying that it's the right time for the next week or the next months, but it's more with a 1 year time frame. It's pretty clear that China will reopen, and that there will be a boost in demand coming from China, that at least the credit that the Chinese policymakers are trying to infuse into the economy will have some takers, which was not the case before. So that's why we are quite constructive on China, and the beneficiary in Asia will be the likes of Hong Kong, Singapore, and Thailand, for example.
Yeah, you mentioned about how EM, the bar is so low that we might see some positive surprises. How does the dollar look to you now? I mean, do you think that it is time to sell the dollar? And if so, how do you fade that?
We are still neutral on the dollar, but it's likely close to peaking. The dollar has been driven by really a reset of interest rate differentials between the Fed and other central banks. And as we see the Fed close to the end of the cycle, not yet there, but close to the end, and other central banks also picking up the pace on tightening, the interest rate differential will narrow. The growth differential is also another aspect of the direction of the dollar, and this also could be a bit of a headwind going forward as we see a recession coming in the US. So US dollar might still remain strong for the short term, but if you look into 2023, it's likely to have some weakness.
Bonds are traditionally a good hedge against an inflation, Thomas. I mean, this year's been so bad, inflation and rate hike-wise, even tips are underwater. How would you advise clients around fixed income next year if inflation does remain fairly elevated still?
So what I would say is that bonds are back, yields are back, so it's really getting back to an environment where you have the choice between yields or bond investments compared to other assets. In the past, when you had negative yields, that was quite unusual. So with that, we are quite constructive on credit, although default rates could increase next year as we go into a slowdown in the economy. We think that it will still remain below typical level of default rates during a recession. So 3%, for example, is our forecast next year for US high yield compared to 5% default rate typically in a recession. And why is that? It's because the quality of issuers have improved over the past years. So that's why we believe that in credit, when you can get yields at about 8-9%, you have a good starting point.